Long before coins clinked in purses or digital wallets buzzed with notifications, human societies relied on something far more delicate: trust. In the earliest markets of Mesopotamia, Egypt, and the Indus Valley, people traded not only goods but reputations, relying on honesty, memory, and the word of neighbors. Barter was not merely a system of exchange. It was a complex social network, a delicate dance where human relationships were the currency. A farmer might lend grain to a neighbor with the understanding that the favor would be returned during the next harvest. A potter might craft vessels for a local merchant, expecting future payment in silver or woven cloth. In these transactions, the true wealth lay not in the objects themselves but in the bonds they created. Imagine a Mesopotamian village bustling with life, merchants calling out their wares, traders counting their grain and cattle, children running between stalls. At the center, a farmer and his neighbor sit beneath the shade of a fig tree, discussing the terms of a loan. The farmer offers 10 measures of barley, trusting that his neighbor will repay the same after the next sowing season. To secure the agreement, they inscribe the deal on a small clay tablet, pressed with symbols that convey not just numbers but faith in one another's integrity. This simple act, seemingly mundane, is the earliest whisper of banking, a recognition that economic systems rely fundamentally on human trust. Temples soon became the custodians of wealth in these early civilizations, bridging the gap between personal trust and institutional oversight. In Egypt, priests guarded not only the treasures of the pharaohs but also deposits from ordinary citizens. Temples offered a sense of security that private homes could not, blending sacred authority with practical service. People entrusted their grain, silver, and other valuables to temple vaults, confident that the guardianship of the divine would protect their assets. The temple was more than a religious institution. It was the world's first bank, its walls thick with stone and ritual, safeguarding the collective faith of a community. In Greece and Mesopotamia, temples also played a role in early lending. The wealthy could deposit surplus goods, while borrowers, often merchants or farmers, could access these reserves under agreed terms. Interest, calculated as a fraction of the loan, became a standard practice, embedding an understanding of risk and reward into the social fabric. Yet these transactions were never purely mechanical. Human judgment remained central. Priests and scribes weighed character, reputation, and previous behavior alongside material collateral, demonstrating that banking has always been as much about psychology and ethics as arithmetic. Consider a Babylonian scribe tasked with overseeing multiple loans simultaneously. Each transaction involves not only numbers but personal histories: who has repaid faithfully, who has defaulted, and which promises can be trusted. The scribes quill scratches across clay tablets, capturing agreements that intertwine economic necessity with social accountability. These early records remind us that banking is not just about accumulation of wealth. It is a codification of trust, a recognition that societies thrive when individuals honor their obligations. While temples and scribes provided security, lending also carried profound human dilemmas. Borrowers faced the tension between survival and obligation, between immediate need and long-term honor. Credit became a moral as well as economic concept. One could imagine a small farmer borrowing seed to plant his fields, hoping the next harvest would be sufficient to repay the temple and sustain his family. A missed repayment could carry social repercussions, altering the borrower's standing in the community. Banking, in its infancy, was inseparable from the moral fabric of society. The first financial systems also reveal an early awareness of accountability and record-keeping. Clay tablets, stone inscriptions, and papyrus scrolls served as permanent evidence, ensuring that promises could be verified across time and space. These artifacts were more than legal instruments. They were tangible manifestations of human foresight. In them, we see a civilization grappling with the challenges of memory and continuity, challenges that would echo through the ages, from Renaissance ledgers to cloud-based financial databases today. Pause for a moment. If you could witness the first banking transaction in history, what would you see and who would you trust? Perhaps a farmer exchanging grain under the shade of a fig tree, or a merchant depositing silver in the sanctuary of a temple. Each act embodies the delicate interplay of human confidence, social norms, and the shared understanding that the survival of a community depends on honoring commitments. Even in these earliest moments, banking was about more than money. It was a manifestation of human cooperation. As civilizations evolved, so too did the complexity of their financial arrangements. In ancient Mesopotamia, scribes began to standardize contracts, creating templates that could be reused for multiple transactions. These early systems allowed communities to scale, accommodating growing populations and increasingly diverse economic activities. In Egypt, temple banks expanded their operations to include international trade, offering loans to merchants traveling along the Nile or across the Mediterranean. The core principle remained the same. Trust underpinned every exchange, and careful record-keeping ensured that promises could be enforced without relying solely on memory. The evolution of lending practices also reflects an early understanding of risk. Lenders weighed the potential returns against the possibility of default, developing rudimentary interest structures and collateral requirements. Borrowers, in turn, had to demonstrate reliability, often through a combination of reputation, past performance, and tangible assets. These early financial calculations were not abstract. They were deeply human, rooted in relationships and lived experience. A merchant who defaulted risked not only financial loss but social exclusion, illustrating that banking has always carried moral as well as material consequences. Human stories from this era abound. Picture a young scribe in Babylon carefully inscribing the details of a loan agreement, aware that this document could affect the lives of entire families. Imagine a farmer crossing the river to deliver repayment, nervous that a misstep could damage his credibility and livelihood. Visualize a priest mediating disputes over deposits, balancing the divine authority of the temple with the practical needs of a growing economy. These narratives reveal that the history of banking is inseparable from the stories of ordinary people navigating trust, obligation, and ambition. Temples also played a crucial role in fostering broader social stability. By acting as repositories of wealth and facilitators of credit, they enabled communities to undertake projects that would have been impossible for individuals alone. Irrigation systems, city walls, and marketplaces all depended on the pooling of resources and the reliable extension of credit. In this sense, early banking was not just a private endeavor but a public good, illustrating how financial systems can amplify human cooperation and collective achievement. The symbolic power of the temple as a custodian of wealth cannot be overstated. To deposit valuables in a temple was to engage in a ritual of trust, intertwining economic activity with spiritual observance. This dual function reinforced confidence, ensuring that assets were protected not only by human authority but by divine oversight. The intertwining of faith and finance demonstrates an enduring truth. Successful banking systems rely on confidence. Confidence in institutions, in agreements, and in the shared values that bind societies together. As communities grew, so too did the sophistication of their financial instruments. Contracts became more detailed, incorporating contingencies and provisions for unforeseen circumstances. Loans could be repaid in installments or with variable interest, reflecting a nuanced understanding of human and economic behavior. These innovations were driven not by abstract theory but by lived experience, by merchants negotiating across cities, farmers balancing seasonal yields, and priests mediating disputes. The lessons of these early systems resonate today, reminding us that finance, at its core, is a human endeavor shaped by trust, accountability, and foresight. By the time coinage emerged centuries later, these early practices had laid the foundation for more complex banking systems. The principles established in barter economies and temple banks, trust, record-keeping, risk assessment, and moral accountability, would endure, evolving alongside technology and society. From clay tablets to coins, from ledgers to digital wallets, the thread of trust has remained the central pillar of finance, connecting generations across time and space. Centuries after the first clay tablets recorded loans and deposits, human societies discovered a new way to embody trust in a tangible form: coinage. The birth of coins marked a pivotal evolution in the story of finance, transforming the abstract promise of value into something you could hold, exchange, and transport. Coins were more than metal discs. They were symbols, assurances that a standardized, universally recognized value could circulate among strangers across cities, kingdoms, and continents. The first coins appeared in Lydia, a kingdom in western Anatolia, around the 7th century BCE. Crafted from electrum, a naturally occurring alloy of gold and silver, these coins were stamped with designs indicating their origin and authenticity. The Lydians understood that people needed a trusted standard, something to replace the cumbersome barter system, where value depended on negotiation, persuasion, and local familiarity. Coins simplified exchange, enabling merchants to trade confidently, knowing the metal carried a universally acknowledged value. From Lydia, the concept spread quickly. Greek city-states adopted and adapted coinage, inscribing their symbols, gods, and city emblems onto small discs of silver and gold. Each coin carried both practical and cultural meaning, a form of money and a statement of civic identity. Imagine a merchant in Athens navigating the bustling agora, weighing silver coins against goods from across the Mediterranean. These coins allowed him not only to buy olive oil, wine, and pottery, but also to engage in cultural exchange, paying for foreign goods with an object that carried the implicit trust of its origin city. Microstory. Picture a Greek merchant, his hands dusty with flour and grains, holding a small silver coin stamped with Athena's image. He travels to a coastal port and meets a Phoenician trader offering exotic spices. The merchant hands over the coin, and in return, receives saffron and myrrh, items he has never seen before. In that moment, the coin serves as more than currency. It is a bridge between cultures, an artifact of trust that transcends language and borders. He marvels at the interconnectedness of the world, understanding that money is not just metal but a shared promise. Meanwhile, in China, the development of coinage took a different yet equally transformative path. Around the 4th century BCE, Chinese states began producing standardized bronze coins, often shaped like spades or knives. These coins facilitated domestic trade across vast regions and fostered the emergence of organized markets. In China, coins became embedded in everyday life, used to pay taxes, settle debts, and support the sprawling economy of dynastic kingdoms. The symbolism of coins, stamped with the authority of rulers, reinforced societal trust. The state guaranteed the value, blending governance with finance. As coins spread, the need for more sophisticated trade mechanisms became apparent. Merchants traveling long distances could not carry vast quantities of metal for every transaction. Enter credit systems and merchant networks, the next leap in financial innovation. In Venice and Florence, burgeoning trade hubs of medieval Europe, letters of credit and bills of exchange allowed merchants to settle debts across cities without moving gold or silver physically. A Florentine merchant could pay a supplier in Alexandria without ever touching the coin, relying instead on written promises enforced by reputation, contracts, and trusted intermediaries. The Silk Road, stretching thousands of miles from China to the Mediterranean, created a lattice of economic interdependence that depended entirely on trust. Caravan traders, often separated by months and thousands of miles, relied on established networks, personal reputation, and meticulous record-keeping to ensure goods and payments arrived as agreed. The human element was central. A merchant who failed to honor a letter of credit risked not only financial loss but social exclusion from a network that spanned continents. Every transaction was a lesson in ethics, patience, and foresight. Microstory. Imagine a Venetian merchant shipping silks to Constantinople. He sends a letter of credit promising payment upon arrival. Weeks later, the recipient confirms receipt, trusting that the coin will follow through a banking intermediary. The merchant breathes a sigh of relief, understanding that every letter, every signature, every seal carries weight. Trust is as valuable as the cargo itself. In this interconnected world, the human bond behind every transaction is as tangible as the coin in a purse. Beyond Europe and Asia, banking practices began to evolve across cultures, integrating knowledge and principles from diverse civilizations. Islamic banking, for example, developed sophisticated commercial principles while adhering to religious prohibitions on interest. Merchants in the Islamic Golden Age employed mudaraba and musharaka partnerships, blending risk-sharing and ethical finance. Their methods enabled expansive trade networks across the Middle East, North Africa, and beyond, ensuring that financial systems remained resilient and culturally grounded. In medieval Europe, banking institutions took cues from earlier Mediterranean practices, incorporating double-entry bookkeeping and structured lending mechanisms. In China, merchant guilds and state banks introduced instruments to facilitate long-distance commerce, including paper money and promissory notes. These cross-cultural innovations illustrate a critical truth. Financial systems are not merely technical. They are deeply human, shaped by social norms, ethical frameworks, and intercultural exchange. Knowledge moved along trade routes just as goods did, creating a shared global heritage of banking innovation. The exchange of ideas was often as transformative as the coins themselves. A Venetian banker might study ledgers from Cairo. A Chinese merchant could adapt Middle Eastern practices to local markets. This cross-pollination of knowledge accelerated financial sophistication, allowing societies to manage risk, encourage trade, and foster prosperity. Banking, in this era, became more than local exchange. It was a mechanism for global connectivity, a reflection of human ingenuity and cooperation on a planetary scale. Pause for a moment. If you could witness the first cross-border trade using coins and credit, what would it teach you about trust? Would you marvel at the careful letters of credit, the meticulous calculations of interest, or the personal relationships that held entire networks together? Every coin exchanged, every note signed, every promise honored demonstrates that money is more than metal. It is a social contract, a tangible manifestation of confidence in others. Trade networks also created new opportunities for storytelling and cultural blending. A merchant returning from the Silk Road would bring not only spices, silks, and precious stones, but also stories, languages, and ideas. Coins and letters of credit became the vehicles for these exchanges, connecting human experience with economic necessity. One could trace the flow of culture through trade ledgers as easily as through caravans, revealing the intertwined nature of money, trust, and human interaction. The human element remained critical in every transaction. Unlike modern automated banking, early finance depended on observation, negotiation, and reputation. A merchant's integrity was as valuable as the coin he carried. A misstep, a falsified letter, a missed repayment, could reverberate through networks, affecting not only individual fortunes but also social cohesion. Banking, in this sense, was a moral enterprise as much as a commercial one, reflecting the values of honesty, responsibility, and reciprocity. Coins also influenced daily life in subtle ways. Standardized currency allowed ordinary people to save, invest, and plan beyond immediate survival. Farmers could exchange surplus grain for coins, which could then be used to purchase tools, seeds, or luxury goods. Artisans could accumulate wealth, invest in workshops, and hire apprentices. The social implications of coinage were profound. Economic mobility became possible, and communities could undertake projects and initiatives that were previously unimaginable. As commerce flourished, banking innovations spread rapidly. Venice became a hub for letters of credit, Florence a center for ledger-based banking, and Cairo a nexus of trade and Islamic financial expertise. Chinese innovations, particularly the use of paper money, facilitated unprecedented domestic trade. Each society adapted and improved upon existing practices, demonstrating a fundamental human trait, the drive to innovate collaboratively across borders and generations. By the end of this period, money had transcended its material form. Coins, letters of credit, and promissory notes were no longer just tools of trade. They were symbols of trust, reputation, and interconnectedness. Financial systems became instruments of social cohesion, weaving together distant regions into networks of obligation, confidence, and shared prosperity. Money became a universal language, conveying promises as much as value. As Europe emerged from the shadow of the Middle Ages, commerce began to flourish in ways that demanded more sophisticated financial systems. The Renaissance, a period defined by cultural rebirth and intellectual awakening, also sparked a revolution in banking. In cities like Florence, Venice, and Genoa, merchants, aristocrats, and artists all needed reliable means to manage wealth, fund ventures, and facilitate trade across vast distances. It was during this period that modern banking, as we recognize it today, began to take shape. Florence became the crucible of innovation, where families such as the Medici transformed banking from a localized craft into a structured, regulated institution. The Medici banks were pioneers of double-entry bookkeeping, an accounting method that allowed them to track loans, deposits, and transactions with unprecedented clarity. Each ledger was a reflection not only of numbers but of trust, a meticulous record of promises made and kept. The system allowed bankers to manage multiple clients simultaneously, from ambitious merchants seeking to expand trade networks to noble patrons commissioning artworks. Microstory. Picture a Florentine banker in the early 15th century. He sits at a large wooden desk under the glow of sunlight filtering through the narrow window of the bank, quill in hand. Noblemen await loans for land and titles, while artists and architects seek funds to complete cathedrals and frescoes. Each transaction is a negotiation of faith as much as finance. If the banker miscalculates or a client defaults, the ripple effects could be catastrophic, affecting families, guilds, and even the city's reputation. He carefully inscribes every promise, aware that his work binds not just numbers but the destinies of individuals and the city itself. Beyond Florence, banking innovations spread throughout Europe. Venice, with its thriving maritime trade, developed intricate systems of bills of exchange, allowing merchants to settle debts without physically transporting coins. These instruments required meticulous record-keeping and trusted intermediaries, reinforcing the social and ethical dimensions of finance. Banking was no longer simply about storing wealth. It became a medium of cooperation, risk management, and civic responsibility. The evolution of banks coincided with the emergence of paper money and centralized financial institutions. In England and Sweden, the first regulated banks took shape, laying the groundwork for modern monetary systems. These institutions issued banknotes representing standardized value, a significant departure from purely metallic currency. The public's willingness to trust paper, backed by institutions and governments, illustrates a profound human principle. Money only works if people believe in it. Trust, carefully cultivated over generations, became as critical as the currency itself. Stories from this era underscore the fragility and resilience of financial trust. In England, the Bank of England was founded in 1694 to manage government debt and stabilize the economy. Early banknotes circulated among merchants and citizens, yet skepticism and panic were never far away. Rumors of insolvency or overissuance could trigger public anxiety, demonstrating how human confidence is the linchpin of economic stability. A single breach of trust could cascade into crises that touched everyone from the wealthiest aristocrat to the smallest tradesman. Risk, speculation, and public confidence were intimately linked. Markets were vibrant but volatile, and human behavior often dictated the fate of economies. Speculators might gamble on commodity prices or government bonds, while ordinary citizens depended on banks to safeguard their savings. When trust faltered, consequences were immediate: bankruptcies, social unrest, and disrupted trade. The Renaissance and early modern period reveal a profound lesson still relevant today. Financial systems, no matter how sophisticated, are inseparable from human behavior, ethics, and perception. Microstory: imagine a merchant in London during the late 17th century. He has entrusted his savings to a local bank that has issued paper notes representing a fraction of the gold reserves it holds. News spreads of a potential failure, whispers that the bank has overextended loans and cannot cover withdrawals. Panic ensues. Lines form outside bank doors, merchants and citizens alike demanding redemption. In the chaos, the merchant must navigate fear, trust, and survival, understanding that economic stability is a human construct as much as a technical system. The Medici and other Renaissance bankers also confronted similar dilemmas, albeit in a different social context. Florence was a city of intense rivalry, where political intrigue and familial ambition could imperil even the most successful bank. Loans to princes, commissions for art, and funding for overseas trade carried enormous risk. Yet by maintaining meticulous records, cultivating trust, and balancing risk and reward, these early bankers created financial frameworks capable of supporting cultural and economic flourishing. Central banks, emerging in the 17th and 18th centuries, institutionalized this trust further. In Sweden, the Riksbank implemented standardized note issuance, providing citizens with confidence in paper money. In England, the Bank of England served as a stabilizing force during wars and economic expansions. These institutions reflected an understanding that money's power derives not from the metal or paper itself but from collective faith in its value. Human trust, recorded and reinforced through regulation and transparency, became the cornerstone of modern finance. Beyond regulation, the period also illustrates the interplay between individual ambition and societal oversight. A single default could have devastating consequences, while successful ventures fueled trade, innovation, and cultural achievements. Risk management became both art and science, requiring acute attention to human behavior, economic trends, and geopolitical realities. Banking was no longer a private affair. It was a public enterprise affecting the prosperity and stability of entire communities and nations. Microstory. Consider a French merchant in the 18th century financing a trade voyage to the Caribbean. He negotiates a complex network of loans, letters of credit, and insurance policies. The success of the journey depends not only on weather and navigation but on the integrity of each financial actor along the route. One misstep, a delayed payment or miscommunication, could unravel the venture, highlighting that every decision in banking is intertwined with human relationships and trust. By the mid-18th century, financial literacy and public confidence had become central to societal stability. Newspapers reported on exchange rates, banks issued statements to reassure customers, and letters of credit enabled global commerce. Individuals, whether merchants, nobles, or common citizens, engaged daily with financial systems that demanded judgment, ethics, and foresight. Banking was no longer confined to elite circles. It was part of the social fabric, shaping behavior, opportunity, and trust. Reflecting on this period, it becomes clear that the evolution of modern banks was as much a story of human ingenuity and moral judgment as it was about accounting and currency. Trust had to be earned, maintained, and sometimes restored. Systems of checks and balances, audits, and standardized procedures were developed to codify these principles, ensuring that banks could support growing economies while maintaining confidence. The human element, ethics, reputation, and diligence, remained as central as any technological or procedural innovation. Imagine lending money to a stranger in a faraway city centuries ago. How would you decide whom to trust? What factors would you consider? Reputation, collateral, or social connections? This reflection invites us to connect with the people of the past, understanding that the principles of finance have always been deeply human. Risk management also took on a cultural and philosophical dimension. Economists, bankers, and scholars debated the nature of interest, the ethics of speculation, and the limits of financial risk. Literature and correspondence from the period reveal anxiety, ambition, and moral reflection. Banking was a lens through which societies examined not only commerce but the values that underpin civilization: honesty, foresight, and communal responsibility. The era of modern banks also saw innovation in instruments beyond currency. Bills of exchange, promissory notes, and early forms of insurance allowed individuals and institutions to distribute risk across networks, enabling ventures that would otherwise be impossible. These tools were deeply human in origin, reflecting creativity, collaboration, and the recognition that collective participation enhances both security and opportunity. From the Renaissance through the 18th century, banking evolved from a craft practiced by a few families into a structured, regulated system capable of supporting national economies and global trade. Trust, carefully nurtured over generations, became formalized yet remained fragile. It was a living principle dependent on human behavior, reputation, and ethical stewardship. The lessons from this period echo into the present day. Financial stability, innovation, and prosperity are inseparable from the people who design, operate, and interact with institutions. The dawn of the digital age transformed banking in ways that Renaissance families and 19th century financiers could scarcely have imagined. Where once the careful hand of a scribe recorded every transaction on paper ledgers, now computer systems process thousands of transfers in a fraction of a second. Electronic banking, born in the latter half of the 20th century, marked the first profound step toward a world in which money could move as fast as information. It was a shift not just in technology but in the relationship between humans and trust itself. The earliest innovations were modest yet revolutionary. Banks began to digitize accounts, storing balances on magnetic tape and later on computer hard drives. At first, these systems handled only the simplest operations, deposits, withdrawals, and interbranch transfers, but they laid the groundwork for a fundamental reimagining of what banking could be. A small business owner in Chicago, for instance, might have spent hours manually reconciling ledgers, counting cash, and traveling between branches. With the introduction of electronic transfer systems, she could settle accounts with suppliers in minutes, freeing time to focus on growth rather than bookkeeping. Microstory. Picture her opening her modest store one morning in the early 1970s. She logs into a new electronic system, skeptical at first, uncertain if she can trust a machine with her livelihood. Her first transaction is simple, paying a local supplier for a batch of goods. The screen blinks confirmations in green, and her payment is complete. Relief mixes with awe. In that moment, she realizes that the world of banking is expanding beyond the physical walls of the branch. Money can move invisibly, yet securely, across distances once measured in miles by foot or horse. ATMs, or automated teller machines, further revolutionized the relationship between people and banks. Introduced in the late 1960s and early 1970s, ATMs offered a simple but profound innovation: access to one's funds at any hour, without requiring direct interaction with the teller. Suddenly, cash could flow outside traditional business hours, democratizing access to money and reinforcing the concept that banking was no longer tied to location or office hours. Communities began to adapt. Businesses closed less frequently for banking needs, travelers could withdraw funds far from home, and people began to internalize the idea that financial autonomy was now technologically enabled. The rise of credit cards and global connectivity further accelerated these changes. With a simple plastic card, individuals could conduct transactions anywhere, trusting networks to authenticate and record their activity. Credit cards introduced a new layer of trust. People were no longer relying on coins, paper, or local ledgers, but on vast systems of verification and financial accountability. Human behavior remained at the core. Responsible usage, timely payments, and adherence to agreements were essential. Yet the scale was unprecedented. Millions of users interacting with systems that had no physical intermediaries, bound only by trust in technology and institutions. Microstory. Imagine a traveler from Tokyo visiting New York in the 1980s. She purchases a ticket for a Broadway show using a newly issued credit card. At the moment of payment, a network spanning continents verifies her account, approves the transaction, and updates balances almost instantaneously. To her, it feels magical. To the engineers behind the system, it represents decades of effort translating centuries of human banking trust into a digital architecture. The experience exemplifies how banking, while increasingly technological, remains rooted in human judgment, confidence, and interaction. The Internet revolutionized banking once more. Online banking platforms began to emerge in the 1990s, allowing individuals to check balances, transfer money, and pay bills without ever visiting a branch. This transition mirrored the evolution of knowledge itself. Information that had once required travel, time, and personal interaction became instantaneous and accessible. Mobile banking, fintech apps, and digital wallets took this even further, transforming smartphones into personal financial hubs. Families could manage household budgets, make cross-border payments, or invest in markets halfway across the globe with a few taps on a screen. Microstory. A family in Nairobi discovers a mobile wallet in the early 2010s, enabling them to send money instantly to relatives in rural villages. The father, once reliant on long bus trips and intermediary agents to transfer funds, now completes the transaction from his phone while preparing breakfast. The mother uses the same app to pay school fees and buy groceries, bridging gaps of distance, infrastructure, and time. This new world of digital finance does more than transfer money. It reconfigures daily life, strengthens social bonds, and empowers individuals in ways previously unimaginable. Yet, with innovation came new challenges. As banking moved online, the fragility of trust shifted from physical safes to encryption protocols and server uptime. Cybersecurity threats became an ever-present concern. Hackers could potentially disrupt access, steal funds, or manipulate records. Individuals and institutions alike were forced to rethink responsibility. Passwords, two-factor authentication, and vigilant monitoring became as important as locking doors in centuries past. The human dimension remained critical. Even the most sophisticated systems could not function without careful, responsible stewardship. Privacy, too, became a pressing issue. Digital transactions create vast trails of personal data, raising ethical questions about surveillance, consent, and ownership. Users must navigate these systems with awareness, understanding that while technology enables unprecedented access and speed, it also requires vigilance. Trust in this context is no longer solely interpersonal or institutional. It extends to algorithms, networks, and unseen operators, reflecting an expanded, interconnected conception of accountability. The evolution of banking illustrates a recurring theme. Each technological leap reshapes not just the tools of finance but the human relationships at its core. Electronic transfers, ATMs, credit cards, and digital wallets all depend on the enduring principles first encoded on clay tablets: trust, accountability, and the capacity to coordinate across distances. Technology amplifies human capability, but it cannot replace the foundational social contract underlying every financial system. If you could send money instantly across the world without cash, what possibilities or responsibilities would come to mind? How would you balance convenience with the trust required to maintain stability? Pause and consider how each transaction, no matter how small, connects you to an intricate web of human ingenuity, ethics, and societal infrastructure that spans centuries. As fintech innovations accelerate, banking continues to evolve. Blockchain, peer-to-peer payment systems, and decentralized finance represent attempts to distribute trust even further, removing traditional intermediaries while preserving security and transparency. Yet even in these highly technological systems, human behavior remains central. Code cannot compensate for poor judgment, negligence, or ethical lapses. The digital age, like all periods before it, demonstrates that trust, while increasingly mediated by technology, remains an inherently human enterprise. The expansion of digital finance also highlights the democratizing potential of banking. Individuals previously excluded from traditional institutions now gain access to credit, savings, and investment opportunities through mobile apps and online platforms. This shift echoes the broader historical arc, from clay tablets and temple vaults to paper ledgers and now digital wallets. Banking has always been a means to enable human agency, growth, and interconnectedness. Access to reliable financial systems empowers individuals to plan, trade, and innovate, reinforcing the lesson that trust is both a personal and collective responsibility. Every technological innovation comes with its lessons. Early adopters of online banking learned that convenience must be paired with vigilance. Users discovered the importance of strong passwords, secure connections, and understanding transaction mechanisms. Institutions invested in encryption, fraud detection, and consumer education. In essence, each step of digital banking mirrors the lessons of the past. Systems can amplify capability, but human judgment, ethics, and accountability are irreplaceable. As digital wallets, mobile banking apps, and online platforms become ubiquitous, society faces both opportunity and risk. Cross-border commerce, instant payments, and financial inclusion are now possible at scales unimaginable in previous centuries. Yet the reliance on complex technological systems introduces vulnerabilities that require constant attention. Trust, though technologically mediated, remains the foundation, a reminder that even the most advanced tools cannot substitute for social, ethical, and institutional responsibility. In examining the digital revolution in banking, we can see a through line connecting every era of financial innovation. From early barters and temple-led loans to Renaissance ledgers and modern online transactions, the principles remain consistent. Human ingenuity, trust, accountability, and the desire to connect and cooperate across distance and time. The digital age is simply the latest chapter, expanding the scale, speed, and accessibility of banking while preserving its fundamentally human essence. The essence of banking has never been about coins, notes, or digital numbers alone. At its core, it is about trust, a delicate, intangible force that allows individuals and societies to coordinate, innovate, and thrive. From the first temple loans to the vast digital financial networks of today, banking has always mirrored the collective belief of a society in one another. Every transaction, every credit extended, and every promise fulfilled is a testament to humanity's capacity for cooperation and foresight. Consider the modern banker, sitting in a sleek office overlooking a city of blinking lights and ceaseless activity. She manages digital systems that process millions of transactions each day, ensuring the safety and accuracy of accounts held by individuals, businesses, and institutions across the globe. Her work is invisible to most, yet it embodies the same principles as those followed by Medici bankers centuries ago: meticulous record-keeping, ethical diligence, and unwavering attention to trust. Microstory. She pauses to review a flagged transaction, a potential cyber breach. Each decision requires judgment, expertise, and ethical reflection. The consequences, though unseen by most, ripple across communities, demonstrating that the responsibility of safeguarding trust is as human as it is technical. Trust in financial systems is fragile. History offers countless examples of its erosion: bank collapses, market panics, and financial crises that have reverberated across generations. In 2008, a modern crisis unfolded with startling speed, reminding the world that even the most complex institutions depend on human behavior, confidence, and collective perception. Individuals, often distant from the decision-making centers of banks, felt the consequences of trust broken. Yet, as in centuries past, recovery required diligence, regulation, and a recommitment to ethical stewardship. Microstory. A small business owner, facing frozen credit lines, navigates uncertainty with a mix of fear and ingenuity, relying on new lending structures and guidance from local community banks. In adapting and persevering, she exemplifies the enduring human resilience embedded in financial systems. The fragility of banking is mirrored in its memory. Ledgers, records, and historical archives carry the weight of decisions made long ago. Early financial records, whether etched on clay tablets or printed in ink, preserved knowledge of transactions, debts, and social obligations. Modern equivalents, digital databases, blockchain records, and cloud backups aim to replicate this continuity. Yet each system is vulnerable to failures, hacks, or obsolescence. Stories of recovery, whether reconstructing lost accounts after a technical failure or safeguarding data against cyber threats, highlight the ongoing human labor required to maintain financial continuity. Each preserved record is an echo of centuries of accumulated trust and knowledge, reminding us that banking is not only functional but cultural and historical. The evolution of banking also underscores the role of individuals in economic stewardship. In the Renaissance, merchants and bankers made decisions that affected cities, trade networks, and political stability. Today, digital wallets, investment platforms, and online banking apps place similar responsibilities into the hands of everyday users. Financial literacy, ethical decision-making, and attention to personal and societal finance are crucial. Microstory: a young professional in Sao Paulo manages a diversified portfolio via a mobile app, balancing investments with savings while learning about risk management and ethical investment. Each choice connects her to centuries of financial history, demonstrating that responsible participation in economic systems is both a personal and collective act. Modern digital systems, while enabling unprecedented speed and access, amplify the importance of human judgment. Instant cross-border transfers, cryptocurrency exchanges, and algorithmically managed investments depend on the careful oversight of individuals and institutions alike. The technology magnifies capability but cannot substitute for ethics, foresight, or communal responsibility. Human trust, guided by knowledge and moral accountability, remains the backbone of any functioning financial system. The story of banking teaches us lessons far beyond money itself. It is a chronicle of civilization, illustrating how humans organize, cooperate, and manage risk collectively. From ancient temples safeguarding grain and precious metals to Renaissance ledgers, early banks, and digital networks, each era demonstrates the duality of innovation and vulnerability. Systems can expand capacity and connectivity, but they remain anchored in human behavior. Every successful financial transaction, investment, or loan reflects a network of trust spanning centuries, connecting us to the ingenuity, ethics, and foresight of those who came before. Every transaction, investment, or saving decision connects us to a history of trust spanning civilizations. How will you honor that legacy? Pause to consider the implications. When you save for your child's education, invest in a startup, or transfer funds internationally, you are participating in an unbroken chain of human collaboration that has endured for millennia. Your choices, though seemingly small, are threads in a fabric woven by countless generations. Digital banking, in particular, emphasizes both the promise and responsibility inherent in trust. Encryption, authentication, and secure protocols are technological manifestations of ancient principles. They codify reliability, integrity, and accountability. Yet these systems require ongoing human engagement. Users must safeguard credentials, understand the risks, and participate ethically. Institutions must maintain transparency, enforce standards, and anticipate vulnerabilities. Together, these actions maintain continuity in a network that stretches across borders, time zones, and cultures. Microstory: in a rural village in Kenya, residents adopt mobile banking for the first time. A farmer transfers earnings from a seasonal harvest to his children attending school in the city. For the first time, funds that might have required days of travel are available instantly. The success of this transaction depends not only on technology but on the farmer's understanding, care, and ethical use of the system. It is a vivid illustration that trust, whether in coins, ledgers, or digital protocols, remains fundamentally human. The fragility of financial memory is not limited to crises or technology failures. Market volatility, speculative bubbles, and historical mismanagement serve as reminders that systems are only as stable as the collective judgment and ethics supporting them. Human societies learn from these events. Regulations are refined, oversight is improved, and education is emphasized. Financial systems are living institutions, evolving as humans experiment, err, and innovate. Reflection on past lessons ensures resilience for future generations. Banking also carries a metaphorical weight. It is a mirror of civilization. Each innovation, from double-entry bookkeeping to electronic funds transfers, embodies cultural values, ingenuity, and a desire to extend trust across distances. Just as early coins facilitated cross-cultural trade, today's fintech systems connect families, entrepreneurs, and communities worldwide. Every successful transaction is a reaffirmation of shared values: honesty, diligence, and the capacity to coordinate for mutual benefit. The human dimension of banking remains central even in the era of algorithms and automation. Financial literacy, critical thinking, and ethical conduct are necessary complements to technological infrastructure. As individuals, we are participants in a broader system. Decisions regarding saving, spending, lending, or investing ripple through networks, affecting both our immediate communities and distant participants. Each choice is a small but meaningful act of stewardship, linking us to the centuries-long evolution of finance. Microstory. A small tech startup founder in Berlin uses a crowdfunding platform to raise capital for an innovative project. Investors from across Europe and Asia contribute funds digitally. Each pledge depends on trust in the platform, the founder's integrity, and the promise of ethical and transparent use of resources. The successful launch, enabled by modern banking systems, reflects an intricate combination of technology, human judgment, and historical principles of trust. In reflecting on the continuity of banking across millennia, one realizes that innovation alone is not sufficient. Systems thrive when human responsibility, ethical standards, and collective trust are maintained. The silent labor of vigilance, accountants, bankers, regulators, and everyday users, sustains networks that, if neglected, could collapse under the weight of negligence or malfeasance. History teaches that stability is a deliberate act, requiring conscious effort and care. The metaphor of a flame is apt. Each era of banking, temple loans, coinage, Renaissance ledgers, central banks, and digital systems, represents an ember of human ingenuity and trust. Passed carefully from generation to generation, these embers illuminate possibilities while warning of fragility. When nurtured, they enable civilizations to grow, connect, and innovate. When neglected, they flicker, threatening to extinguish hard-earned confidence and stability. Today, as we conduct transactions through digital wallets, online platforms, or traditional banks, we participate in a continuous story stretching back thousands of years. Each payment, each investment, and each decision reinforces a network of trust established long before us. It reminds us that the principles underpinning financial systems, integrity, responsibility, foresight, and mutual respect, remain timeless. Every transaction, investment, or saving decision connects us to a history of trust spanning civilizations. How will you honor that legacy? Pause to consider your role in this ongoing story. When you choose transparency, responsibility, and diligence in managing money, you are not merely safeguarding wealth. You are sustaining a human tradition, a quiet flame that has guided societies for millennia. From clay tablets to mobile wallets, every coin, note, and digital transaction carries the weight of human trust. A quiet flame illuminating the continuity, resilience, and responsibility of civilizations across time.